Appreciate you taking some time today to learn more about the power of investment real estate, how it can impact your financial future. But specifically, we're going to drill down on a strategy, the short-term rental exception, that you don't have to wait years or decades to realize those benefits. Something that you get upfront the year you purchase it. Dramatic tax savings, money left in your bank account because you're participating in an investment that can help you be in a better place over the decades. My name's Mike Chamberlain. I'm part of the Done For You real estate team that for nearly 2 decades now, we've been helping busy, successful investors own single-family investment real estate in markets around the country where the numbers make sense, where they can own it from a distance, stay focused on what they do best while they wait and experience the long-term benefits of real estate on the side. It's something that you obviously recognize as a value, as most Americans do. The fact that Gallup's been doing surveys for 100 years, and when they ask Americans what they view as the best long-term investment, real estate's often at the top of the list here. And that's also the case with high net worth investors. There's this organization where they have an average, each member has an average net worth of $100 million. And when they're asked in their annual surveys how they're investing their money, they report back that over a quarter of it's invested in real estate. That number is often between a quarter and a third of the high net worth people and high income earning people's portfolios are invested in real estate because of its physical, tangible benefits, being a hedge against inflation. All the tax savings, all the things that are appealing about real estate. Often when somebody is busy and successful in investing in REITs or syndications, like most of these people, they're not capturing all of the benefits of investment real estate. We're going to show you how you can own the property outright, have that control and flexibility, realize all those benefits yourself without it taking over your life. I've been helping people with investments for nearly 2 decades now, over 2 decades actually. I've helped them with traditional investments. I've helped them with a myriad of vehicles. There's nothing I've ever helped somebody invest in that gives them 4 different ways that you can benefit, like you see here. Income that builds up. Appreciation that happens eventually, not every year, but always eventually. When you have a loan on it and the tenant's renting your place, the tenant's the one paying off your loan. So that principal reduction, and then the tax savings. Again, we're going to focus on that today, but it's worth emphasizing you don't get all 4 of these benefits every year. Sometimes real estate goes down, sometimes you have messiness, but one of these is working at all times for you. And usually all 4 are. And when you have that combined, that multiple stream of benefit, you can really be in a better place long term. And then you combine that with the fact that it's a physical, tangible, believable, relatable kind of asset. I've just seen it help investors have more confidence that the future will be okay, more hope that they are building a legacy for their beneficiaries and that they will have something they can turn to later in life that can have a dramatic impact. So I love what investment real estate does for the peace of mind for investors. And what you need for peace of mind is some certainty. And in the short run, you don't get certainty. You get messiness and you get all kinds of different experiences. But in the long run, I like looking at charts that the Federal Reserve puts out. And what we can see here is that over long periods of time, rental real estate goes up. Sometimes it goes down. Most of the time it goes up. And if you take all the good and the bad and you say, what is that average over long periods of time? 4% a year is an average annual appreciation. 4%, when you compound that with leverage, if you're buying with a loan, you tend to get 3 times that appreciation. 3 times 4 is 12. I've done hundreds of reviews with our 1,500 clients, and eventually that is what it always ends up looking like, is a multiple on that appreciation. And that appreciation happens over time. The other thing that's so certain about real estate is that rents go up over time. It can be a great hedge against inflation. What a retiree needs to have a successful, long, passive income in retirement is they've got to have a source for income that doesn't end. And a roof over someone's head is not a luxury, it's a necessity. There's always going to be a tenant that needs a place to live that will pay the owner that rent to be able to live there. So you need an income that doesn't end, but you also need an income that outpaces inflation. I think it's interesting looking at the same Fed charts here, that what you could buy for $1 in 1970 now costs $8, And what a single family home in America rented for in the same time period, starting in 1970, is now 9 times. So the rents have increased at a pace not much higher than inflation, but just outpacing the cost of living. which is dramatic alone. But then you compound that with appreciation happening behind the scenes, principal reduction, tax savings that can be realized upfront and along the way. And it just leaves you in an advantageous position. It adds certainty that the future is going to be okay. And now we have some real certainty with the One Big Beautiful Bill that was implemented this last year. One Big Beautiful Bill Act that has made 100% bonus depreciation accelerated and able to be captured in the year that you purchase that property, to have some real savings in the amount of taxes that you owe the year you purchase that property. That's where we're going to focus here. Maybe just real quick to give you some place to check in. I'm not an accountant. Check with your accountant to see what's applicable for you. But if you have a household income that is in your marriage filing jointly, or you can look at the single column over here, you can see where the different rates go from essentially no federal taxes all the way up to 37% in federal taxes. The progressive tax rate, of course, that the higher your taxable incomes are, the higher the percent that you pay. That's just one form of taxes, of course. That's the federal tax. There's usually state taxes on top of that, and sometimes local taxes. So it's something that most of our clients are experiencing somewhere between 30 and 50% of their income as being taxed to some sort of entity. And so that's one of the great things about real estate is the government will incentivize certain behavior, of course. They want there to be safe communities with good homes where the citizens have safe places to live and educate and grow and contribute to the community. And so they have a tax incentive because when you buy investment real estate, you are a business owner and you're entitled to all the other business benefits that the IRS is incentivizing and our representatives in Congress to help you pay less on taxes if you're willing to contribute to society in certain ways. Housing, agricultural, energy. Obviously, we're focused on housing here, but real estate has benefits that can help investors be able to keep more of their money with writing off most of the actual expenses. And when you can align a lifestyle with some of these benefits, it's a way that can also help you reduce some of your lifestyle income as well. It also has benefits if you were to sell properties and not use the 1031 exchange, but just sell them, you're paying a reduced capital gains tax rate. And when you have positive income, if your depreciation doesn't wipe it all out, you're not paying FICA and FUTA taxes. So you get some income benefit that way. And not to mention recapture, there's a chance for arbitrage there, all kinds of ancillary ways that you can benefit throughout the years-long ownership of investment real estate. But some of the real powerful tax strategies with investment real estate is being able to, when you sell a property, not have to pay taxes when you use the 1031 exchange, being able to sell an old home and buy a new home, sell in a market that's not performing as well, buy in a better market, and keep all of those gains to roll into the next properties, giving you ability to grow a portfolio that way. You're also able to do cash out refinances when you own properties. It's only when you sell a property without a 1031 that it becomes taxable. You can do a cash out refinance, park the money in your bank and go buy another investment property if you're in the growth stage of your life, or supplement your income if you're in the distribution or retirement phase of your life without a taxable event, without triggering taxes. Loans are not taxable. They're not even reportable to the IRS as a potential taxable event. And so the cash out refinance can have dramatic impact in somebody being able to access what eventually is usually the best benefit of real estate long-term, which is that equity appreciation, but doing it in a way that helps you retain more of it. And then you can own that same home until you die, or when you sell a home and buy another one, you use the 1031 and have this home that often doubles every 15 years or so. Depends on what appreciation does, but it's usually 15, no more than 20 years that it takes for a home to double in just average kind of appreciation. And if you buy a home for $250,000, it doubles the first time to $500,000. If you own it for 15 or 20 years, if you own it for another 15 or 20, 500 goes to $1 million. Not if we get lucky, just if we get average. And if you buy that $250,000 home that's worth $1 million the day you die, that's your beneficiary's new cost basis. They get a step up in their cost basis, where if you sold it without 1031, you're paying taxes. They inherit it and sell it. They don't pay a dime of taxes. And if they keep it, they get a reset depreciation, which is helping you pay less on taxes the whole time you own it. So that gets us to this depreciation tax benefit. Depreciation has been part of real estate for years now, but we're going to focus on accelerated depreciation and how that will impact you. Done for You has been helping people do this for years now. We've originally started with long-term investment properties where we developed systems and processes to help somebody find, fix, finance, build a property with tenants, and then meet with them with annual reviews and ongoing service to help them grow their property from 1 to 2 and 2 to 4, et cetera. We've done that with nearly 1,500 clients that we've helped over the years, over 1,500, excuse me. And we have processes and systems that help with that overall experience. We originally started here in the West, here in Utah. When the Great Recession happened, that's when we developed our current business model, which is go to where the numbers work. And during the Great Recession, you had half price kind of deals in Vegas and Phoenix. And so we've helped people buy hundreds of properties in those markets. But then when homes started to increase in the West and rents didn't scale with them, we then went to the East and the Midwest now, where the numbers still work. I think it's interesting to see this pin drop map of where we're currently helping people purchase properties here, those yellow colors, and reflecting it on an affordability chart here on the right, where an average price of a home in America is 4.5 times the household income. So if a household has $100,000 in income, the average price home would be $450,000. But you'll see in the darker colors, especially in the West and in the East, where home prices have become less affordable. They've been priced out of the average household being able to buy that property. But there are still parts of the country where they are more affordable. And it just happens to be those lighter areas where we're helping people purchase most often these days. And again, the path of growth, skating to where the puck's going to be, but doing it in a way that's still affordable and can project to be a good investment for long term for our investors. We've been doing that, like I say, for 20 years with long-term investment properties. And about 5-6 years ago, we had a lot of requests from our clients to look at short-term properties, Airbnbs, VRBOs. We did that. We looked into it and never quite felt comfortable with the added risk and expense that were inherent with just short-term permanent properties. But in the process of that research, we came across a midterm property management company in Oklahoma. A Real Home Away is their name. Now, most people haven't heard of midterm properties. You can think long-term as 12 months or more, unfurnished homes. You can, of course, relate to short-term furnished place that you can rent for more. And midterms, that happy space in the medium, in the middle there, where it's often rented for 1 to 6 months at a time and being filled by insurance companies, executive placement companies, traveling nurses, people who may have had a kitchen burned down in their home, and their insurance company is going to pay to fix that. But in the 2 or 3 months that it takes to do the work, they're going to set them up and have the insurance company pay for a comparable home in the neighborhood where they can live and be comfortable while the repairs are done. So there's a myriad of different ways that these midterm rentals have been filled with different tenants. But the property management company, Real Home Away, has spent years now developing relationships with these tenant placement companies, these insurance companies, executive placements, and others. And they originally were helping people do that just in the Oklahoma City area. But over the last couple, 3 years now, we've helped them grow and scale. Very organized, competent people there as part of the Real Home Away team, very experienced, and have been able to help our investors grow into additional markets in Oklahoma, in Dallas, Fort Worth, Texas, and in Indianapolis, Indiana so far. And it's still in the scaling stage. As demand grows, we'll be able to scale and meet that demand. And the thing that they do with these midterm properties, the nice thing about them is we don't help people buy high-end luxury homes. We certainly don't help them buy low-end C-class homes, homes that on paper may look better, but in reality, the experience is often messier and not as good. We help people buy high demand, good quality homes. And with the midterm property, it's even a step higher with this would be an example property in Oklahoma, where you can see this is an actual property that we had available this last week for an investor to purchase, where you can see that it's a nice place that would be comfortable for somebody to live for a short period of time while they're waiting to find their new home, if it's somebody that got transferred with work, or somebody that's waiting for their home to be finished. Or they also rent out short term rather than have midterm rentals sit idle and not generate any kind of income. They'll target the short term rentals to generate some income as well. And so this is the kind of property. And what we do with Done For You is we partner with licensed agents that know the markets that we're in, that live there, that know the neighborhoods to look in, that will find the homes that match the likely best scenario for an investor to own over a year's time. They'll present those homes to our property management team that will get a second set of eyes on them, put it through their filter and say yes or no. We expect this could be a good rental in our portfolio, and say we believe that we can rent it on average for this amount. In this case, this is a $350,000 home in Oklahoma City that the property manager suggested on average it would likely rent for about $4,100. That's not every month. Some months are going to be $5,000, some months are going to be $3,000. You're going to get an average somewhere close to that targeted amount historically. And with an investor being able to purchase that, we're advocating about a 30% down payment. You can do it with less, 25% down. But if somebody were to put 30% down and then purchase the furniture for the property, pay a real home away to stage that, to place that furniture, have it professionally interior decorated and designed, and then get it rent ready, the total all-in costs that this would likely be, including the fees to get a loan from the bank, the fees to get our help, all in total out of pocket that for this particular property, you can see here is about $166,000. And so there's a good chunk of that that's equity in the home, $105,000. There's a good chunk of that that's furniture, $35,000, and all those expected closing costs. And so what we do is we take all this feedback from the agent, from the property manager, and then we put it through our filters to create this property analysis with the assumptions that, if it does rent for $4,100 a month, that would be about $49,000 a year. You take out the taxes, the insurance, the utilities, the HOA, the property management fee, and your biggest expense, that principal and interest payment. And if these projections were to hold true, you would have about $900 a month in positive income for that $160,000 investment. So that's what we do here is we have the filters and the experience and the process and the systems to help reduce a lot of that footwork for the investors to be able to take a snapshot of investment that's been through several layers of filters and make that decision to purchase a property based on its projected analysis here. And so this is something that we do for long-term properties. We've been doing for midterm properties. We've helped our clients purchase over 100 of these over the last couple of years. And what we're helping people tap into now is with the One Big Beautiful Bill Act, there's a accelerated depreciation that allows an investor over time to tap into parts of that home. Now, when you buy a property, let's explain this a little bit. Investors have always been able to take the depreciation on that property over the IRS's scheduled lifespan of 27 and a half years. So let me break this down a little bit. Here's a property that, again, costs about $350,000. These are all estimated values, but $350,000, it's usually, the industry often uses 80%. We've seen with our homes, it's about 84% of the purchase price is attributed to the home itself, the structure, the above ground expense of that purchase price. There's about 16% of it that's the land, and the IRS doesn't let you depreciate the land. So if you have a home that's $350,000 and you're just doing standard depreciation, it's about, again, 84% of that purchase price that most of our clients are able to experience. Of course, you'll be working with your accountant and county records and appraised values to get these exact numbers. But if it was 84%, there's about 294,000 of that. That the default that most investors do is just simply take 1/27.5 of it, or divide that by 27.5, the number of years that standard depreciation is, to realize about $10,000, almost $11,000 of reduced taxable income each year you own that property. That phantom loss, that depreciation that we all know investment properties go up over time, but because this is the equipment you need to buy to purchase your to run your business, and real estate investment is a business, rather than buying equipment for a dental practice or buying a walk-in refrigerator for a restaurant, you're buying a property, and that equipment gets depreciated according to that IRS tax incentive and benefit. And so this is what most people have been doing is taking this and spreading it out over 27 and a half years. But you can take parts of that home, components of the home that the IRS says has a less than 20-year shelf life, let's call it, and accelerate the depreciation on that. And rather than take it over 27 and a half years, you can take part of that depreciation And with the One Big Beautiful Bill Act, you can now accelerate that and take a bonus depreciation the year you purchase that property. And so, appliances, carpet, flooring, etc., are the type of experiences that are parts of the property that you can accelerate and take up front. And when you do that, you have to do a cost segregation study. We help people get connected with engineers that can do that, or they can work with their own accountants to do that. But it's often about a third of that depreciable amount that they can accelerate and take it that first year. So a third of 294,000 is 97,000. And then there's still 2/3 of that amount. Instead of taking 10,000 for 27 and a half years, you take 97,000 for 1 year, but you take 2/3 of that depreciable amount and you continue to experience that over the 27 and a half years. And so what you can do when you do this accelerated bonus depreciation is you get a big chunk of that tax savings front loaded, future value of money type of principle here, that you combine then with the normal depreciation for that first year. And then when you're buying a short-term or mid-term property and you have some additional upfront costs like that furniture and make-ready expense, that's all part of Section 179 taxes that you can realize and write off of your taxes the year you purchase it. So we add all these different parts of this investment up, and you get to about $139,000 of this $160,000 investment that you may be able to reduce your taxable income the year you purchase it. Pretty dramatic if you're able to realize and have the types of income that can benefit from all that. Depends on where your tax bracket is. But if you're in the 37% tax bracket, that's federal and state. If it adds up to 37% of 139,000 is about $51,000. This strategy can make it so about 1/3 of the cost of purchasing this investment property can be regained by leaving about $51,000 in your bank account the year you purchase it and not have to send it to the IRS. This is a buy three, get one free kind of thing, because this is the number if it's 30% down. If it's 25% down, it's about 149,000. 5 times 3, 51,000 times 3 is more than what the total out of pocket would be for about a 25% down investment. So dramatic ways to potentially reduce your taxable income the year you purchase this. But you have to have the right kind of income, like we said. And so what is that? Now, if you have homes that you've already purchased that you own outright with cash, you're probably paying taxes on some of that positive cash flow already. So you may be able to benefit from just adding that depreciation of a new purchase to help offset other kinds of passive income. It might be paid off properties. It might be a loan that you made to a passive business partner. Think of it as a silent business partner where they opened up a pizzeria and you're lending them $100,000 and they're giving you 10% income from that non-active passive participation as an investor. And that kind of passive income, you can also reduce and not have to pay taxes on because of this depreciation and accelerated bonus depreciation that we're talking about here. You can have other kinds of ways to tap into that. Or if you happen to be a household that makes $150,000 or less, you can also offset your other active income from this passive loss just because of that income bracket in the type of investments that we help people do qualify as active investment. And so they're able to realize some of it that way. Another strategy that some people will employ is being a real estate professional. There's hoops to jump through, and busy, successful people themselves usually cannot qualify for this. But if there's a spouse that is not working full-time outside the home, if there's somebody else that can qualify for it, we've had clients that have jumped through the hoops and done the things they needed to do in consultation with their accountants to be able to claim that real estate professional status, and that can help them reduce other kinds of active income with this kind of what's normally passive losses from real estate. But what we're really going to focus on for the rest of this introduction is this strategy here where for a first year of property purchase, you can buy one of these, what ultimately will be a midterm investment strategy where it will become a passive, turn it over to a property manager to manage for you kind of investment. But for the first year or part of a year that you're involved, you can participate 100 hours or more in different kinds of activities that will allow you to take advantage of the short-term exception. So the reason why most passive real estate investment can't offset your active W-2 high earnings from your business that you own or other kinds of income is because it's categorized as two different kinds of income, passive versus active. But when you actively participate, and what is 100 years? I'm sorry, what is 100 hours or more in a year? It could be that you buy a property in January and you average 2 hours a month for the year. It could be that you buy a property in November and you jump in for 2.5 weeks. You're there full time, spending time helping get the property ready to rent and then helping it rent in December. Whatever that looks like, that first partial year, you do have to participate. There is no squirming around this. You do have to do the kinds of activities that IRS has said an investor needs to do to turn it from passive to active ownership. And if they do that, then they're able to take that active loss now in real estate and offset their active income. So if it's a doctor making $500,000 a year and a spouse is working on getting the home ready and participating in its management and rental, that participation from the spouse can help offset the active income from the other spouse, whatever that occupation is, whether it's W-2 income, whether it's high earning entrepreneurial income, whatever that is. And so the caveats to keep in mind here, and there's all kinds of details that we help make sense of and work with our clients to be able to meet the qualifiers for, is that for just that first year, you do have to participate 100 hours or more and more than anyone else. And it does need to rent on average for 7 days or less throughout the year. One rental's for 10 days, another rental's for 3 days. That's an average of 7 days or less. So there's things to be aware of, and you have to commit to this strategy to make it work. But if you do, you can be dramatically compensated by keeping more of your hard-earned money in your bank account than rather than having to pay it to the IRS. Now, we do things to help with that process. We have education to break down the kind of activities. We have tools to help you track those activities. And we have a relationship with the property management where this, again, let me just take a minute to talk about a real home away. We kind of feel like we're cut from the same cloth in that these are people that want to have a good experience for the investors, that are partnered on the same side of the table to help this be a good overall experience and return for you, and are willing to help with the experience where you can, from a distance, participate in the furnishing and the managing and the placing of the properties, again, for that first year to the extent that you need to, and then be able to turn it over January 1 to the property management to take over and turn it into a much more passive involvement that second and each year afterwards, that second year and each year afterwards. So this is the strategy, lots more details that we can help make sense of it, but it's something that's being well received, especially from high income earners. People who are making monies that are giving up, a third to a half of it, are quite motivated by what this can do to leave more money in their bank account. And just to illustrate as to what the return on investment can be, just from a 100-hour perspective, obviously it depends on what your income is and how much you're paying to the IRS, your different marginal tax rates. But if we take that same example we gave previously and come up with that $139,000 of accelerated depreciable first year Section 179 kind of expenses, and relate it to whatever your incomes might be, around 130, 240, 500, or $800,000 in these different scenarios, the equivalent tax savings, if you're not having to pay your combined tax rates with those different income rows, it can be dramatic, from 23,000 up to 58,000 in these different scenarios. Or if you attach an hourly equivalent, take those annual savings and divide it by the 100 hours you have to participate in, and it's a number dramatically more than what most people are making, whether it's the $130,000 category that would be the equivalent making about $60 an hour, but actually saving about $230 an hour in taxes because of jumping through these hoops. That's dramatic. That's incentivizing for a lot of people. And I just want to emphasize briefly here that this is all within the bounds. This is the incentives that the IRS has set up. There's nothing new with this. The One Big Beautiful Bill Act has made it permanent until Congress changes it. It's made it clear. It's made it timely. But there have been tax incentives to incentivize certain behaviors for eons of time, of course. And those tax incentives, I think it's interesting to get some perspectives from some legal minds here. U.S. appeals court judges, as well as the U.S. Supreme Court judge previous, that says in America there are two tax systems, one for the informed and one for the uninformed. Both are legal. Supreme Court Justice William Rehnquist, there's nothing wrong with a strategy to avoid the payment of taxes. The IRS doesn't prevent that. I appreciate Arthur Godfrey's humor where he said, I'm proud to pay taxes in the United States. The only thing is, I could be just as proud for about half as much money. And then this final one, everyone should pay taxes, but there's nothing in the code that says that you have to leave a tip. So I am of the opinion that most individuals can do right by their family and right by their community through nonprofit charitable giving and other ways to be involved and give back by keeping more of their money. And the IRS code actually recognizes that and incentivizes people to behave that way. And so it's something that we've now formalized a process for investors to be able to tap into, recognizing they're busy and successful, acknowledging that they have to make a commitment for that first year to be a little bit more involved, but then being able to turn it over and have an investment that can continue to benefit them in other ways for years and decades to come. So you don't want to make an investment decision just based on the tax savings alone. Although those tax savings are very valuable, it's not what you make with an investment, it's what you keep that's most important. But of course, with investment real estate, that tax savings was just one of the ways that you benefit. Here's that same example. Here's that property that was about $900 a month or about $11,000 a year in projected positive cash flow. That $11,000 a year, if you don't need that $139 to offset other active income the year you purchase that, if you're just wanting to bank, you could literally add upfront tax savings as well as the ongoing annual depreciation and have decades, even 27 years of projected tax-free income from this investment property. $11,000 a year that if you were paying taxes on, you would actually not need $166,000 to invest to get that same kind of $11,000 return. But with that same kind of 7% projected average annual return, if you were paying taxes on it, you see here down at the bottom left, you'd need about $263,000 that at a 7% investment return, income return. That's hard to get these days. It's usually called a junk bond. You get a quality A-rated bond and you're getting more like 4 or 5%. But if you were to get 7% somewhere and then had to pay taxes on it, you would need literally 58% more of your money to net out the same amount that you can keep just because of the tax benefits of real estate. That's the tax savings, emphasizing the income that can be mostly passive over decades' time. And that's even just a small part of how you benefit from real estate. Ultimately, the biggest part historically has been when that home goes up in value, because inflation drives up the home's value over time. Historically, homes have appreciated just above historic inflation rates. And when you buy in markets that are growing faster than national averages, which is what we're helping people do, we buy in markets that are growing twice as fast as national average population growth, which is the number one indicator for better than average appreciation. And so our markets over long periods of time have historically gotten 5% or better for our investors. And that $350,000 investment, if it grows at just 5%, 10 years later would be worth about $570,000. And in that 10 years time, the tenants have helped you pay off $39,000, almost $40,000 of the loan that you took out to help buy that, to take advantage of that power of leverage, to get a multiple on that equity appreciation, that return on your investment over time. You've literally increased your equity net worth, your wealth, by over $250,000 in this illustration. On top of the tax savings, on top of all the things that it does to give you some confidence, the benefits, what I call the benefits of real estate, that will be there and really help you later in life, not to mention the legacy impact. I love what real estate can do for you today and eventually. And that's what we do here at Done For You, is we help investors take advantage of that in a way that doesn't take over their lives, that has been proven over decades' time. We get over half of our business from our clients coming back and repeating, getting our help to buy again and again because it works over time. And we'd love to help you do that as well. I appreciate you taking the time to learn more about it, and we would invite you to meet with a Done For You representative where they can look at your specific situation, customize it, and help you take advantage of this process and system that's in place and the incentives that the government have made permanent now to help you have a better financial future. Thanks.